right, let's get started. And I'm sure others will keep trickling in. But again, hi, everyone. I am Lori Tiernan, Chief Strategy Officer from Valkyrie. Really excited to be here again with you today. I have Loren Asmus from Canterbury Consulting and Matt Louie from Canterbury Consulting today. Thank you for being here, Loren and Matt. Really excited to hear from you. And of course, our CIO, Steven McClurg, is here to answer all of the questions you have on the digital asset class. I will, for those that are new to Valkyrie, give a brief overview of who we are and what we do. We are a digital asset manager. We have products that provide exposure across this asset class, from ETFs to a DeFi hedge fund. We are launching a stablecoin yield product. We have multiple single asset trust, as well as a multi-coin trust offering, and are launching a venture capital fund this quarter. So we do all things digital assets. We try to provide a product for any type of appetite in the space. We do a lot of programming and research and education in the space as well. Bitcoin Answers is one of those. We do try to be a resource to you. So if you have any questions after this that we can be helpful with, please don't ever hesitate to reach out. And we do hope it's helpful. If you have questions, please just put them in the chat and we'll try to get to them. Thank you so much for those that did submit questions online when you registered. We will try to get to those as well if we can. But I do want to kick it off with Loren and Matt. If you guys could give maybe an overview, a background on yourselves and then on Canterbury, and then we'll hop right into the fireside.
Great, thanks, Lori, and thank you for having us. We're excited to do this webinar. So I'm Loren Asmus. I am primarily cover fixed income and credit research for Canterbury Consulting. We're a $30 billion consultant based in Newport Beach, California, covering institutions, endowments, and foundations, as well as families and family offices. And really, crypto, digital assets have become a lot more of interest to our clients over the last few years, especially the last 2 years in particular. And so both Matt and I have really been trying to understand this environment and try to bring questions and potential solutions for clients as well within digital assets. Matt, I'll turn it over to you for your introduction.
Hi, everyone. Matt Louie. I'm excited to be here. Steven and Lori, thank you so much for having us on. Just really looking forward to chatting. As Loren mentioned, we have a variety of clients ranging from private clients to institutional, and a variety of levels of understanding and interest in crypto, but that's slowly been ramping up over the last few years. And I've been covering public equities, both long only and long short, for most of my entire time at Canterbury over the last 7 years. And recently, we started up a informal task force to study digital assets and educate our clients, educate ourselves, and begin building up our knowledge. Wanted to get ahead of potential transformation and new asset class to invest in. But I think we're still very early stages in that, very, very early innings of understanding and of client interest. And so that's why it's great to be here and to ask you a lot of questions today that we're getting from our clients.
Yeah, maybe to that point, Matt and Steven, really, I think high level would be great to talk about the macro environment first and foremost. Obviously, there's a lot going on in a lot of other asset classes outside of crypto. But maybe we can start with your views on just general macro trends, what we're seeing with inflation, recession fears, and maybe we can dig into how that is affecting the crypto market.
Great. Well, first of all, I'm going to say that, usually when the Fed begins to tighten, like it's doing now, in most other environments, markets will end up following rates up. So markets are getting overheated, the Fed begins to tighten, markets continue to go up for a period of time because the punch bowl isn't quite taken away yet, right? And as those markets go up with tightening, eventually what happens is there's a breaking point to where the markets will start going down, and or the Fed will start sensing fear and they'll start to pause. What's different about this market than the last few tightening cycles that we've seen, and this is going back, 20 years, is that we're in a high inflationary environment. So we all know that the Fed is absolutely determined to fight inflation. The issue is really inflation started setting in well over a year ago, but there was a narrative that inflation was transitory. And rather than taking action, the Fed decided to argue that inflation was transitory, there's nothing to do here. And that was actually the time to start taking action. And when inflation finally got to a point to where it was probably a bit unmanageable and the Fed had to start taking swift action, they started making announcements back in September and October that we're going to start unwinding the balance sheet in a way. They're actually not unwinding it, but they're just slowing down their purchases and slowing down the increase to the balance sheet through March. And then at that point in time may start rolling off, which also signaled that rates would start to rise, or they would start increasing rates in March. And when the market really started taking that seriously in October, that's when markets started going down. They didn't even wait for the first rate hike to come. So now that now that the market has come down pretty significantly, NASDAQ's down 30%, 30-year treasuries are down 30%. The Barclays Ag is down 6%, S&P is down 20%. We still have a few more rate hikes to go. So we're now on a trend where the Fed is still committed to increasing the Fed rate. They're still committed to unwinding the balance sheet, and they're committed to do that until they begin to start controlling inflation. And inflation is nowhere near being under control. So we actually expect the next two rate hikes to be 50 basis points each, June and July, and for the S&P to potentially go down another 30%. So we might see S&P at 3,000. We do expect to see bond prices go down as well as rates go up. We'll probably see the 5-year north of 3%. We got close in the last couple of days, and we'll probably see an inversion of the yield curve. That being said, crypto is also a risk asset being treated much like a NASDAQ equity right now. So crypto could take another 20 to 30% hit. The good news is that crypto is already taken the biggest blunt of the attack, and now it's really equity's turn to continue to go down. So we expect a slow melt in all risk assets all the way probably through the midterm elections.
So Steven, what you just said is obviously very concerning for me and for us, where primarily our allocations for our clients are in those major categories of equities and fixed income. And you mentioned crypto at the end there, and this is something that we don't have as much history or background in studying. How will it potentially perform under these types of environments? One of the narratives that was circulating prior to this year was that crypto, in particular Bitcoin, would be somewhat of a hedge against inflation. It would be act akin to a digital gold type of asset, which gold has been historically a place where people can hide during times of inflation. And as you just mentioned there, it's traded more like a growth tech stock, and it's gone down along with everything else. So has that narrative, is that broken? Is that thesis not true? And if it is, why isn't it acting like that?
Yeah. So I think in the long run, and that's a very good question, in the long run, Bitcoin will continue to act as an inflationary hedge. It has acted like that in certain periods of time, but we're also in a very unprecedented time right now where all risk assets are being hit, and assets actually trade the way that people trade them. So if you're, for instance, a portfolio manager that holds a combination of equities and other assets, and you include crypto as well, which a lot of hedge funds are doing this now. They have a 5 to sometimes 10% allocation to crypto. When markets begin to go down like they are right now, you're going to sell out of what you perceive as the riskiest, but also the most liquid assets first, regardless of what they potentially could be the hedge of. So if it's a Saturday and you're getting news, the equity markets aren't open yet, and you're going to trade crypto. If it's after market hours, you're going to trade crypto. So, so the first thing that's being sold off are crypto, and like you said, they're being treated like growth equities, growth tech equities, which is going to be the first to go. Defensive stocks are going to be the last. So, so that's the first thing that people start selling out of. And then the next thing, of course, and we're already seeing this, are other growth tech stocks that many are down 70% right now. And now, as we're entering recession, and we talked about this a little bit earlier before we all came on. Q1 has proven, as the numbers for Q1 are out, and it's already negative GDP growth, and I expect Q2 will be as well. And if you particularly look at the numbers from Lowe's, Kohl's, and Target over the last couple of days, Target being a particular concern, where it really shows that consumer spending has dropped almost entirely for unnecessary goods. So we're probably going to see that across the board. And Target being one of the largest retailers, and having the results that they have had over the last quarter, and pretty disappointing forward guidance, because we're already a month and a half in. It really shows that Q2 might end up being a pretty poor quarter, especially if Target is suffering the way it is. So I'm really looking at Target as the bellwether of, we're down 25% yesterday, and really poor forward guidance. What's the rest of the market going to look like? What about the smaller retailers that people might abandon altogether? And that's really where we might see some equities, some retail equities go down more than 30% over the next few weeks or months.
So in terms of thinking about the performance of Bitcoin and other digital assets going forward, is it as simple as waiting for a pivot from the Fed, going from hawkish to dovish? Or is it or maybe, also you look at the Dixie DXY, we're at almost all-time highs there. And there's definitely been an inverse correlation between the strength of the dollar and the performance of Bitcoin and other digital assets. So I guess, how do you kind of think about all these different correlations and also implications from monetary policy?
Yeah, so the point of the Fed is a really good point, and that's exactly where I stand. I've always been of the belief that you don't fight the Fed, and until the Fed takes a shift in policy, either going neutral or dovish again, I would not expect a bottom, and I certainly wouldn't call a bottom. We have this thing in the world of crypto called the Fear Greed Index, which takes a lot of factors, but usually when the Fear Greed Index hits a certain number, that designates a bottom. And a lot of people have called a bottom 3 times already this year. It's gone down, the Fear Greed Index is really low, and it's like, okay, this is the bottom. The Fear Greed Index is exactly where it's supposed to be, and then it might pop a little bit and then go back down again. This is almost entirely Fed driven across the board, and so until we get that statement from Chairman Powell, I'm very hesitant to call a bottom. Now, we have gone down to a point to where there's other factors that I like to look at too when it comes to Bitcoin. I like to look at hash rates. Usually when hash rates are high, it's a very bullish sign for Bitcoin, and hash rates are extremely high right now. But despite all the other factors that we have, and like hash rate and other items that we look at in Bitcoin and other cryptocurrencies, Fed policy is the dominant factor across the board. So like I said, like you said, until we hear a change in policy, I expect markets to continue to slow melt.
So we've gone this far without mentioning kind of the elephant in the room, or the topic that's on everyone's minds in crypto for the last few weeks. And that's, of course, the collapse of Luna and the cascading impacts on the entire crypto market. Maybe we'll take even a step back from that. And, I think reputationally, crypto has had its ups and downs. And we conducted a client survey that asked our clients what they thought of crypto and digital assets. Is it an important part of the future? Not sure. Is it a scam? Somewhere in between. And this was about a month ago, and particularly on the institutional side, there's been hesitancy to think of crypto as an important part of the future or important asset, part of asset allocation, and especially with what happened in the recent past, that's the reputation has taken a hit from that. So if you could maybe briefly talk about and take the opportunity to talk about not only what happened with Luna, but can investors who feel like maybe they don't fully understand the space, can they feel confident in investing in other crypto products, given that we just saw one pretty much go to zero?
Yeah, absolutely. And and this is really where somebody like us comes in. We at Valkyrie, we look at all the various protocols out there, the various teams that are attached to those protocols, what they're doing. We have constant conversations with developers to see if actual applications are being built on top of it. And we even look at the code for various protocols and associated projects before we spend a lot of time getting involved in it. Bitcoin, we obviously are big fans of Bitcoin. We see that as a future currency for the global digital economy. But when it comes to the other cryptocurrencies that are protocols, we are looking at the protocols themselves. So a protocol like Luna, for instance, the main project that was being built on top of there was an algorithmic stablecoin, a coin that was supposed to be pegged to the dollar. Now, common sense says that if you have something pegged to a dollar, then you should hold dollars against it. And Terra was simply not doing that, or UST was simply not doing that. They were saying, well, we're going to build code, and what's going to happen is if it drops below a dollar, then we're going to issue more Luna tokens to support that, and we're going to sell that into the market to support that dollar. Now, that makes zero sense whatsoever, right? That's basically saying, that'd be like, China saying that, hey, we're going to peg the renminbi to the dollar, but rather than buying treasuries to hold in our foreign currency reserves, we're just going to print as much renminbi as possible to make sure that that peg holds. Well, that's how you create hyperinflation. It's anybody with that's taken a economics 101 would see that is that's not going to work. And and those of us that are out there that took a look at UST decided that UST was not a safe bet, a safe place to be. And the fact that it was so tied into that one particular blockchain, and that it could trigger an instant creation of more tokens and create this hyperinflationary environment, which would cause, for that particular protocol, which would cause that price to go down, it was something to avoid. So that to us was a really bad project. There are other projects that are really good projects, right? Ethereum is an older project that we kind of see as a little bit outdated, but so many things are being built on top of it. It's hard to change. It's sort of like the BlackBerry, right? For the longest time, we held BlackBerries, and we continue to hold them even when the Apple came out, because your corporate emails were attached to it. They understood the security. Most companies took years before they switched over to another device away from a BlackBerry, because they understood the security and it was already built in. Ethereum is sort of like that. It's one of the first. It's the largest. It's very secure. It's going to take a while for people to migrate to other projects, but some of these other projects, like Avalanche, for instance, or Zilliqa, or some of these other ones, are really focusing on building a developer community, building really strong code, strong compliance, and building real projects on top of their protocols. So those are the kind of things that we look at. There's so many other projects out there. I mean, there's thousands of projects, thousands of protocols, thousands of tokens. And look, most of them just simply aren't going to make it. You know, we try to focus on the, 20 or less than 20 projects that we think are really the next, the next good protocols, or the current good protocols that real applications, real life applications, business solutions are being built on top of.
And maybe to that point, Steven, in terms of projects and moving forward within the crypto ecosystem, given this is such a big scar, really. I mean, it was Luna, Terra was a top 10 token and, went to zero. I guess, what are some other lessons learned from that experience? And, just thinking about, some of the warning signs, like I believe it was the Anchor protocol, where you can earn 20% interest, if you were to stake your UST, your stablecoin through Terra. And then also the fact that they were buying Bitcoin as collateral, which maybe is not the best collateral to use for something like that. I guess, kind of, what are some lessons learned, and how do you think the crypto space will move forward from this?
Yeah, I mean, I think some of the lessons, that hopefully people learned in that is actually, is doing real work on, is sort of like credit, right? I came from the credit world as you're very involved there. And anytime that you're just going out and buying bonds because, well, everybody else is doing it, right? It's in the Lehman Ag, so I'm going to buy it. As opposed to doing real credit work and understanding what that company is actually doing, what the risk of a company that's issuing the bond is, what's their potential for default, what's their potential for recovery if they were to default, which jurisdiction they're in, what are your rights as a bondholder, what are the triggers, what are the covenances. You have to, even though those same exact topics don't apply to crypto, the same concepts do, right? What's backing the project, how did they launch, what's the team, what's their compliance, which jurisdiction are they in, do they have real assets backing it if it's a stable coin, what does the code look like, how long has the code been in effect, what's its OPSEC. And these are all the things that you have to look at. And when you start skipping steps and you buy something because it's the next hot thing, it's sort of like buying the next hot stock, right? I mean, we could probably list, numerous examples where there was like, some hot stock that everybody liked that Kramer talked about on Mad Money, and then everybody piles in and then it goes to zero, right? I mean, that's the same thing happens in the world of crypto as it happens on Mad Money. And people like to skip steps, and they're looking for a quick buck, and they buy into things because a personality likes it. Some guy with a Luna tattoo tells you to buy Luna, so you're going to go buy Luna, as opposed to doing real work and understanding what it is that you're buying. These are the kind of things that really have to be careful of and look at. And by the way, it's almost a red flag for me when I see personalities out there pumping things, and talking about things and saying, yeah, you should buy this, without even giving real reasons why. And then the crowd follows, and it's like, okay, well, that's going to end poorly.
Yeah, Steven, I was going to ask you if you personally had any tattoos on your arm, and which crypto we should buy based on that. But no, I know you're doing the work. So this is a great segue into another question that we had. Is one of the top reasons that clients gave in our survey for hesitancy investing in digital assets was the lack of fundamentals to gauge appropriate value. So we understand with companies, you can model out their cash flows, or maybe even the expectation of future cash flows, and kind of discount that into the present, come up with a valuation. But with cryptocurrencies, are you modeling? How are you modeling using a DCF or otherwise the current value, and what you would assign to it, and a target price, and if you would buy it today?
Yeah, I kind of liken crypto to be a little bit more related to a lot of tech stocks that have, and not any tech stock, right? But tech stocks that are really user focused data aggregators, and like I said, user aggregators, right? So if you look at something like Twitter that was aggregating users and then eventually had data on those users, they didn't have cash flow for a very, very long time, but there's still a valuation assigned to it based on the user base. Tesla is another example. Now, Tesla obviously has revenues and has cash flow, but a lot of people that mistaken it for a car company, and try to add it and try to assign a valuation of that is going to get it wrong from a price perspective. You have to look at it like a user aggregation and a data aggregation play, right? Tesla's not in the business of building cars. They're in the business of gathering data from users so that they can build autonomous vehicle technology, right? And figuring out where people are going. I mean, the car tracks every single place you go, when you go, and how and how fast you go to get there, and how often you go there, right? And it's no different than carrying around your phone. Pretty soon, if you use Apple Maps enough, it starts predicting. I'll get in my car and my phone says 15-minute drive to home. Like, it knows exactly where I'm going, and that's the business that a company like Tesla's in, right? But then you apply that to Twitter, Facebook, where you're aggregating users, aggregating data, and those are very valuable things. And the bigger the user base and the bigger the connectivity of those users, the more value is assigned, because eventually that network itself is going to have value. Now blockchain is similar, except it doesn't have the cash flow potential as these other ones are. It's more of a network, right? And the way to really value it is, Bitcoin is valued more like a currency, and the network effect is the number of people that are coming into it and utilizing it, and making transactions with each other, interoperability of users. And that's going to fit alongside, kind of Twitter in a way, but then also it's a currency. So the currency has value because more people use it, right? And I know that's sort of like a circular reasoning, but eventually you have a currency that everybody uses. It's kind of like the US dollar. The US dollar wasn't always the reserve currency of the world, but eventually it was, and it held value and it had strength against other currencies simply because people trusted it and used it for no other reason why than they trusted the rule of law in the US. In Bitcoin, you trust the rule of code, that the code is going to support you. And when it's around long enough, then the code will uphold itself. With the other protocols outside of Bitcoin, these are protocols that things are being built on top of. Like I said, let's take Ethereum, because everybody understands that one, for instance. Ethereum kind of works like cell phone data. So you're building this protocol that you're building applications on top of, just like you build applications for a phone. And ETH, which is the currency of that network, has more value as there's more users and more applications being on top of it, meaning that you have to use their currency to power things on their network, just like you would buying data on a cell phone. We don't experience that as much in the US because we have these data plans where you pay a monthly fee and you forget about it, and you don't understand that. But most other countries, you're paying per data transaction. And so it's a little bit easier to understand for people that are outside of the US that have to pay for that data on their phones. So Ethereum's the same way. And by the way, as there's more value being built, the more people are going to pay for transactions and that value. It also goes up with inflation, right? Because as things cost more, Ethereum will go up in price, just based on inflation around it from other currencies. So it really has two factors on how you can actually evaluate it: what's being built, the number of people using it, user interoperability, and how fast the network is growing.
Yeah, Steven, maybe we could dig into that a little bit further, maybe using Bitcoin as an example in terms of how are you forecasting the adoption rate and the network effects of Bitcoin, say, over the next 3 to 5 years? I was at the Bitcoin conference in Miami a month ago, and I mean, it was great to see how much adoption and interest there is in just Bitcoin alone. and how big that conference was. But a lot of the talk was around layer 2, the Lightning Network, and payment processing over the Bitcoin protocol. So I guess when you factor in Bitcoin's use case there, but then also its store of value use case, how do you kind of extrapolate that into a network effect over the next 5 years or so?
Yeah, well, and we'll go back to hash on this. So the more transactions there are, the harder the miners have to work to process those transactions, and the more efficient they get, the higher hash that the miners are processing, right? So that's really where hash rate comes in. That means that people are utilizing the network, and it's profitable enough for the miners to actually increase their efficiency all at the same time, creating greater hash. And that is where, and that's really where we want to get to. Bitcoin has had a massive adoption curve over the last 10 years. Well, actually 12 years, right? Because, the first transactions really, the first monetary transactions began happening in 2010, even though the test transactions were happening before that. So there's been a massive adoption curve already. And now we're kind of getting up to the point to where that adoption curve is starting to slow down, because as you get more and more people involved in the network, the law of large numbers starts to kick in, and it's not exponential anymore. From a relative basis, it starts to flatten out. But as you've mentioned, we are still very early here, and there still is a massive potential to continue that adoption. We expect adoption to double over the next year, and then from there from a relative basis to start slowing down. It's not going to double every year, right? There's not that many people on the face of the planet. It'll go up by a smaller and smaller factor every year, but that's the adoption rate. The transactions between people should also go up as people begin to exchange with each other across borders. Even in the U.S., where we have strong infrastructure, strong banks, most people are banked, we are starting to see Bitcoin transactions. Other places in the world where the majority of the population is unbanked, that's where we're seeing the larger amounts of transactions, right? And even when we get small countries like El Salvador that are adopting Bitcoin as a national currency, you start seeing a lot of microtransactions happening in those countries and other countries, and it makes it easier to even for people to travel to neighboring smaller countries and utilize a common currency, as opposed to having to trade out of one currency into dollars into the other currency. It was actually a problem that I noticed, when I was involved in emerging market credit, where workers from certain countries would go work, and when they have to send their money back, they would have to trade, from that country's local currency into dollars, and then that dollars country and back into their own local currency. They're paying exchange rates twice, and Bitcoin largely solves that for people in areas that potentially have a common currency, and that's really the places where we're seeing the greatest adoption.
Okay, so let's talk a little bit about risk and return. And this is a framework that we as consultants lean pretty heavily on. And we have a projection, we have assumptions for every asset class and sub-asset class in terms of, over the next 10 years, expected return and standard deviation. And I remember we tried to sort of model Bitcoin into this, and it was just off the charts, like triple-digit returns, triple-digit volatility. And it just was hard to make sense of it. So in the context of comparing it to other assets and trying to fit into that framework, how do you determine or project the risk and return of either Bitcoin or just the digital asset space?
Yeah, and that is really hard. Some of the things that we look at are the wallets themselves. There's a lot of wallets that hold Bitcoin that simply don't trade, don't sell. And these are people that are just holding them long term. Think about them more like, savings accounts, and long-term savings accounts at that. There are wallets that are a little bit more active, and those usually are selling out and then buying back in when when the market comes down. As I mentioned, we look at several different factors. Some of them, like wallets, like hash rates, to determine where the risk return is, or risk reward is. And look, at the moment, we're at a low enough level in a normal market, like I said, where this would be a massive buying opportunity. But given where the Fed is, we're holding off. I still think from a price perspective, this is a good place. And it reminds me back when, at the end of 08, beginning of 09, when all assets were going for sale, right? And the Fed hadn't quite turned it around yet, specifically. I mean, they had, right? They'd already started lowering rates, but it wasn't at enough scale to really matter. It wasn't until February of 09 when Ben Bernanke pledged to throw money out of helicopters that the market's like, okay, these guys are serious. And then that's when the bottom came in, when a real serious commitment came in that we're going to do whatever it takes, print as much money as possible to make sure that this market stabilizes. Then people stopped selling and started buying again, right? So we've got to have that kind of effect from the Fed now, but at the same time, assets are for sale, right? And they're going to continue to be for sale. And if you waited until February to buy, there wasn't enough assets to buy. So, we're already looking at asset prices and saying, okay, well, sure, we could go down another 30%, right? But from a risk reward perspective, our risk is down 30, our upside is, up 200, right? So, it's a good time to start maybe dollar cost averaging in, right? On a really cautious basis. Probably more so when there's more liquidity in the market. But if you wait and try to pick a bottom, there's not going to be enough liquidity there for you to get what you need. So yeah, risk reward is it's an interesting concept in this market, particularly, right? Because even with equities, you're like, okay, do I go all in on NASDAQ right now? No, not at all. You can't. Or the S&P, right? Especially when there's so much downside risk. But yeah, no, there's a lot of different factors that we're looking at, including, like I said, adoption, hash rates, and several factors like that.
And how does regulation factor into all this? Because we talk with our institutional clients, and a lot of them are continuing to be apprehensive because of the regulation or lack thereof. And then obviously, given this Terra incident, I think that's potentially even more heightened now in terms of how regulation may unfold. So I guess obviously macro is one big risk scenario out there, but also regulation. So how do you think about that?
Yeah. So look, I think more regulation is needed. We certainly welcome it. We really don't want things like Terra, Luna in the system. I really hope that that a lot of the companies that were promoting it, are taken a hard look at by regulators, because a lot of retail investors got hurt from from the people that were really out promoting it without having a strong basis to promote it. And we certainly hope that other projects like that are looked at very carefully. Same thing with stablecoins. There's some stablecoins that are really good for the ecosystem, like USDC or Gemini coin, where there's a one-to-one backing to the dollar. It actually helps in the movement of money on a very quick basis. Most of these these coins, they have whitelisting, they have KYC, they have AML. They follow the rules. And then some of the other tokens that don't have backing, that don't have real dollar backing, but claim to be dollar based, or and are algorithmic, I think are going to continue to be a problem. I think it's very difficult to create an algorithm around a stable coin. It's like, I mean, you guys probably see this all the time, where fund managers come to you and say, hey, we built this black box algorithm for equities. It's worked. We've back tested over the last 30 years. It's always going to work. There's always an event that they didn't back test for. And, we saw a lot of that in 08 and 09. We're probably seeing that right now with a high inflationary cycle. There's always another factor that people don't think about And when it's running, when it's a pure algorithm, those factors will always come into play. Same thing with stable tokens. You're not gonna get everything right, and then if you just let it run, there's always going to be a misstep because you missed something.
Yeah. Speaking of stable coins, are there any concerns with the country that the stable coin that is tied to in terms of their currency? If the currency is very volatile, if the interest rates are either negative or very high, is there any concerns with those types of stable coins?
Yeah, I mean, I hate to say it like this. There kind of is. I mean, there are stable coins that are tied to other currencies that might be volatile. I mean, even having a stable coin tied to the dollar, where CPI is at 8.5%, you're basically you're burning 8.5% of value just by holding a stable coin, right? It's a little bit nuts, but yeah, there's certainly currencies out there that are far worse than the dollar, and yeah, those are concerns. But again, at the same time, in the present economy, we utilize the currencies that we utilize. We're not getting off the dollar anytime soon, and most of the world isn't getting off the dollar as a reserve currency anytime in the near term. I think in the far future that might change, but the reality is we utilize dollars. You have to utilize dollars. Other countries utilize their local currency. You have to utilize it, and creating a stable coin that's backed 1-to-1 with that particular currency is beneficial, right? I can't call my bank on a Sunday to wire you money, but what I can do is I can send you a stable coin and it'll get there in 2 seconds. So it's just a way more efficient way of transferring money and getting the money actually in your hands and not on credit.
Yeah, going back to regulation, any insights on what that could look like from either SEC, Congress? Gary Gensler, he taught a course on blockchain technology, Bitcoin at MIT. He probably knows quite a bit about what's going on. How do you think different cryptocurrencies could be classified as well? Bitcoin is not necessarily considered security, but there's still kind of a gray area on whether other coins could be considered security or not. So I guess, how do you think about that?
Yeah, well, first of all, with stable coins, I mentioned the 2 stable coins that we liked earlier. I think that those are going to be pretty safe, and they're going to be stable coins that people are going to use. I think some of the algorithmic stable coins that say they're pegged to a dollar, but they're backed by something other than dollars. Those are probably the ones that are going to be, potentially in trouble as far as being utilized in the U.S. And then one that's on everybody's mind is Tether. Tether, it remains to be seen, but it could be. It could be seen as a money market mutual fund, and it's not registered as such. So that might be a problem. It claims to have a stable dollar. It's backed by, bonds and commercial paper. But the other issue with a stable coin that's backed by bonds is that in this environment in particular, you're, from a price basis, if you were to redeem, let's say all the clients were to redeem all the stable coins, you might end up with a loss because bonds are down, and if by our estimates, Tether is probably only, assuming that it was 1-to-1 when the treasury was created, it's probably only like 1 to 0.95 at the moment, based on where bond prices have gone and based on their holdings of what we know. It could be less, but that's probably best case scenario is 5% less than its stated value. So we'll see the fate of Tether. As far as the other cryptocurrencies go, Bitcoin is clearly not a security. I believe a lot of other tokens out there are, and when we do our work and analysis, we come up with our own opinion, not a legal opinion, but our own opinion based on how the coin was distributed, how it was created, to determine whether or not it would be a security or not, and there's a lot of tokens that we eliminate based on our belief that it could be seen as a security or deemed as a security by the SEC. So therefore we'd want to avoid it.
Mm-hmm. And keeping with the theme of regulation, I think one of the things that's seen as kind of a holy grail for a lot of investors is an ETF that allows you to invest directly in the spot price of Bitcoin, and then even beyond that, more other currencies and investors being able to construct a portfolio of crypto just using ETFs and a vehicle that they're familiar with, that they have easy access to without having to open up a different type of account. And so that seems like it's been something that's on the horizon for a while. I know a lot of firms are kind of in the running for that. What's your outlook on a Bitcoin ETF for this year?
Yeah, we're certainly in the running for that as well, and have launched other ETFs in and around Bitcoin over the last year. But our belief on a Bitcoin spot ETF happening this year is slim to none. I think it'll take at least a year from now before the SEC would consider a Bitcoin spot ETF, primarily because Chairman Gensler has made it very clear that until U.S.-based exchanges that trade and custody Bitcoin fall underneath their regulatory oversight, they would not approve one. And the amount of time that would take, kind of puts us at least a year out. And most exchanges don't want to be under the SEC because what they have on their exchanges aren't considered securities. So Bitcoin's not a security. It'd be like a real estate agent or a real estate broker saying, "Yeah, we're gonna now report to the SEC," even though real estate isn't a security, right? It's why they have their own organizations. The CFTC is very big on having exchanges under them, and that's probably the direction that it'll go. Except, of course, for the tokens that we talked about a minute ago that are potentially securities that would certainly fall under the SEC.
And going back to allocation and asset allocation, and thinking about bucketing for clients of where do you place digital assets, where do you place cryptocurrencies, what are you hearing from other clients, advisors out there, individuals that you work with? We have a few clients that have invested in crypto VC funds, and they've obviously placed that in their private capital bucket under VC. But I guess, how do you think about bucketing and how to place digital assets within the traditional asset allocation framework?
Yeah. So a lot of people are putting it under their private equity or alternative buckets. It certainly doesn't fit under equities. It certainly doesn't fit under bonds. At the same time, we're also seeing a lot of people reduce their exposure to bonds, just given the high inflationary environment and the low rate environment. Even with rates coming up as much as they have, you're still you're on a real rate basis, you're still losing money. So a lot of people have shifted those allocations and increased their alternative and private equity buckets, which has seen an increase in allocation to things like, we're getting a lot of interest, for instance, for venture that is focused on blockchain, and which is why we've launched a venture fund. And then of course, that's the easiest thing for people to allocate to, right? Because it's real equities. The other things that a lot of people are allocating to are ETFs that hold, companies, publicly traded companies that are in the Bitcoin ecosystem. So it's a way to indirectly get that access to cash flowing companies, to things that they understand, and they're sometimes putting that in their alternative buckets, sometimes putting that in their equities buckets. But cryptocurrencies directly is going under alternatives or private equity.
Mm-hmm. And maybe we can zoom all the way out and just if you could share, what are you most excited about in terms of digital assets and cryptos and how they'll change the world as we know it and unlock new possibilities? And we talked about a little bit, transferring money and things like this. But, I know it's hard to, kind of put yourself back in a time before the internet existed and then imagine like all the possibilities that it unlocked. But what are some things that makes you really excited that we may see in the future as a result of crypto and blockchain? And also, on the other hand, what are some existential risks to the space? What worries you as a potential risk to digital assets in general?
Yeah. Well, one of the thing that's always excited me, from the beginnings, I come from an emerging market credit background, and just the potential of a digital currency that's not controlled by any single government, right? Where people can transact around the world, where people can go and work in another country and send remittance back to their families without paying, extremely high fees. Where we can essentially pay people in other countries without having to exchange for higher fees as well. So that's one of the things that's always excited me about it, is just its global nature, its digital economy nature. The other thing that that I've always looked at too is just blockchain and its ability to make financial markets more efficient, right? Whether it's making bond debentures or other types of transactions like real estate transactions more efficient. Anytime you buy or sell a house, you've got that whole packet of papers that you've got to fill out, and it's kind of a pain. And a lot of those things can really be automated, and blockchain has that ability to both escrow and automate a lot of those activities. Look, I think the biggest risk is, a lot of us are here for a lot of the reasons that I described. The biggest risk is, really people coming into the market, creating, speculative type projects and coins that are there for pure speculation and pure money making. And that's bad for anything. Just like there's a lot of these, stock or equity schemes that people dream up, that go and trade on the pink sheets, and people try to pump them, and they all get caught. That same thing's happening here, and you just have to be cautious and really look at the real projects that are doing really cool things, that are causing a massive transfer of technology, and right in front of us, just like the internet did 20 years ago.
Yeah, and maybe I think that's a good place to end our prepared questions, but happy to answer if there's any questions from the audience in the last few minutes that we have remaining.
Yeah, I think we got one that talked a little bit about this concept of, as crypto becomes more institutionalized, right? People open up accounts in their Fidelity IRA, or they open up a custodial account. As I understand it, you're not personally owning the keys, and then so there's this sentiment among particularly Bitcoin maximalists that if it's not your keys, it's not your crypto. What are your feelings towards that? And as we move towards more of these products where more and more of the Bitcoin, let's say, will be owned on behalf of you by some sort of custodian or third party, does that pose a risk to the very thing that was created for, which is to decentralize the ownership of the asset?
Yeah, and really briefly on that, when Bitcoin was first launched, really the only people that knew how to transact it were really smart people that were working on developing it. And it took a long time before there were, the ability for normies like myself to even be able to, buy, sell, trade. And these tools are very important because not everyone understands the tech behind it. But just like any other technology, when our kids grow up, with tech all around them, you know, they're able to do things that we aren't. You know, I mean, my dad used to always ask me to program the VCR. You know, my kids know how to do things that I couldn't even dream of, just because they're inundated on a daily basis. So even though in our generation, in our time, we find some of the tools to use to transact in, you know, in blockchain technology is very difficult. You know, I think our kids are going to get it a lot faster. You know, my 12-year-old, for instance, you know, him and his friends talk in terms of everything blockchain, and they know more about, you know, blockchain and NFTs and everything else than I do. But even a couple of years older than him, you know, my other son just missed that cutoff where they don't talk about it as much. It's not part of their lifestyle. So kind of going back to the question on your keys, yes, a certain amount of my Bitcoin is held in my own wallet, and I own my own keys, and you know, that's that. But I also question myself and my ability, which is why I have a great team around me at Valkyrie, and I also invest in our products so that somebody else manages it for me in case I mess up, right? And I think that's like I think that's a really good policy. You know, if you're an individual, you know, you should strive to own your own keys, own your own wallet. But the reality is that's just not practical for most people. And if you're an investor and represent investors, and you're, you know, investing on their behalf, you probably don't want to do that at all. And you probably want to invest in a fund that holds these things, much like you would hold, you know, a basket of foreign currencies or a basket of stocks on behalf of your clients. So that is the eventual goal in everyday transactions and everyday holdings. And it'll probably take another generation to get there where people can just do all this on their own.
Great. Well, this was wonderful. I really appreciate you guys being here, Matt and Loren. Wonderful questions. I think this will be something that we can take we get a lot of these questions every day in meetings. So I want to take what Steven says and just be able to show a recording to especially institutional investors. So thank you, Steven, for all the information. This was also really helpful with everything going on in the markets. Thank you for being here, everyone. We do this on a monthly basis, and we have several different webinar series. So check out the Learn section of our website to see what else is going on. I will note, if you are trying to get CFP credit and you put in your information when you registered, you will receive that credit in the next week or so. Please let us know. Sometimes there are issues with CFP board. Send us an email and we will be very happy to help. But thank you again to Canterbury Consulting for being here. And thank you for taking the time. Have a great week, everyone.